All right, everybody. Happy Macro Monday, T-Jam, and welcome to week 22. It's going to be super short and sweet, even though I do very much have this view that there are always opportunities out there. I have to admit, in this kind of little pocket that we are in between China and the U.S., there's not too much jumping at me over the weekend, which, of course, does not mean that there's not things to be looking at. But with that said, that is part of also the process. Sometimes it's staying on the side. In fact, I'd argue most of the times it's actually staying on the side, deciding if you want to participate or not, or wait for what you feel is more favorable kind of skews. As always, these solely views and opinions. These not trading, no investment kind of recommendations. So there's a lot ongoing last week. On the U.S.-China, we've had no key breakthroughs, but it was worth noting, unlike 2 weeks ago, we definitely started to get a lot kind of better conciliatory kind of languages going on between kind of two camps, and especially in the Southeast, I believe China Post, there was a piece from the ambassador from China pretty much saying that, they're open to kind of further kind of discussions, and we've also seen softening of tones on also kind of the Trump camp. Again, too early to act too much on it, but just putting it as kind of a note. What is interesting is, if you recall, I believe it was that kind of week of May 10th when the tariffs actually went on that Friday, and I believe around that time Trump was talking about this kind of 3-4 week potential kind of deadline. How official that is, I don't know, but that obviously implies either this Friday, May 31st, or next Friday, June 7th. Just again, food for thought in regards to potential maybe updates coming through by the end of this week or by kind of the end of next week, kind of there. Politically wise, again, we've had some very interesting kind of election results. Looks like Australia set the trend with incumbents. We saw India and Indonesia vote and return their current leaders and party. In India's case, I believe it was something close to like the biggest majority win since the 80s, since 1984. Net, in essence, both viewed as pro-business and positive for both economies and markets, and you could actually see that outperformance happening kind of last week on those equity markets, both the Jakarta Exchange and the Nifty 50 in India. Also, we are getting preliminary results out of the EU parliamentary elections. Apart from France, it seems like it's not maybe as bad as was anticipated in regards to kind of extreme far-right kind of parties, but Macron did suffer some defeats in France. I'm not quite sure what potential maybe implications and the market will be in reading from that, but obviously France does have a special role with Germany kind of being the pillars of the EU. So that could potentially kind of cause complications there. Not too much happening on Euro. We're still around this 112.03 levels where we were on Friday. There are a few interesting Euro crosses that I think are interesting both from the short side, but funnily enough, a Euro-dollar cross itself looks like actually it could be constructive and going to see a little bit more kind of Euro strength. Just a quick comment on market sentiment, and again, this is my view, right? But from speaking to people, chat groups, phones, coffees, lunches, night, day, morning, it's very much, I would say weak sentiment, poor, very kind of bearish in general. Definitely no one, I think, would be surprised with risk off or selling off or things getting worse between the U.S. and China. I'm not trying to suggest that people are necessarily positioned that way, but I think people are definitely not positioned for, let's say, a scenario, albeit potentially low probability, of very, very quick trade resolution, risk on, big positive surprise to the upside. I just don't think anyone is at all in that camp, or if they are, it's a very, very kind of small camp and dwindling at that. Just a quick comment on asset classes. Fixed income, again, tighter and tighter. It was amazing. We'd kind of gone up on US 10s. I believe we got to 242, 243. Now we're back up again, even tighter, just making new lows on a weekly basis. Bunds, ditto, minus 12 basis points, tighter than what we're seeing in JJBs. I would expect some of this may have had to do with kind of the EU monetary election, so maybe we see a little bit of that kind of come through on the tactical side. Again, really, really hard to play short bonds for a long time, just given the structural risk reward for having a core long bond position, given where we are in the cycle, given all the different moving parts between EU and Japan and the U.S., and of course the U.S. and kind of China. Equities pretty much red all across kind of the board again. Only places bucking it were Australia and then Jakarta and India as well. On the commodity side, apart really from oil, which had a magnificent sell-off on Thursday, generally it was actually quite a positive week for commodities as a whole. As Ole also shows in the chart, we'll look at big net increases in regards to kind of commodity positionings, and that was actually before the whole week was out. As you recall, the CART report is as of the close of Friday. But again, despite what I'm saying here, from a sentiment to feel, fear, if you will, we're still not really seeing that expressed in volatility, right? So VIX is pretty much the same levels where we were a week ago. And again, this is always the question, is the volatility there right, or is the sentiment wrong, or vice versa, right? So again, more food for thought. I don't feel very hard kind of one way or another. What I do definitely believe is the regime has changed after May 3rd, where at least on the currency side, up until then, we could have a few weeks of trending moves one way or another. And since then, it's been a lot of kind of very short, mean reverting moves, pretty much even just happening within, one kind of session where you get like a big 30, 40 bips kind of move. And then again, it all kind of gets reversed and then kind of some. This here's a very quick overview of latest positioning on a US dollar basis. Again, always as of the close of last Tuesday. Net long increase from the previous week, which is interesting given that as a whole the DXY did fall back as we lost some dollar strength, especially against the DMs. So we're back up to about kind of 31 billion. And again, from, I guess you could say, a risk-on perspective, right? Obviously, big increase in commodity kind of positioning. Obviously, kind of from quite a few weeks of selling and lowering kind of exposure, but about 73% increase in net long kind of positionings. And this kind of gives you a sense of the change in the contracts, the trend here, but I believe that's the price trend. And then, of course, in regards to kind of extremes, there's only really a few that are extreme, at least from kind of a 12-month perspective. Moving on, just week ahead, and then I'll pass it over to Raymond for a bit of the greater kind of China piece. Again, there's not too much that, at least on my side, is key or game-changing on an economic kind of basis. We do have GDP coming through. We only have one set of PMIs that at least are due this week, which is China's officials, manufacturing and non-manufacturing on Friday. It is also worth noting Bank of Canada is going to be interesting in the sense of, I'm actually surprised we've not seen the loonie strengthen a lot more against the US dollar. They've, again, had blowout retail sales. Prior to that, they had that, out of this world kind of jobs number. We also know Polo's has been at least publicly talking that he's not that worried about kind of the housing market, which is pretty kind of interesting. So it could be another one of these cases where, he or she who does not move actually, stands to move ahead, just given the rate of where everyone else is kind of going from an easing bias, from a race to kind of the bottom bias. So it could be a very, very important meeting for the Bank of Canada in regards to how they are looking compared to the rest of the world, and that's very much how you should kind of be taking it, right? Because there's very much kind of a dovish slant that we're seeing, RBA, RBNZ, very much kind of everywhere kind of else, so to speak. So that could be interesting. Bank of Korea there, again, I don't really have a hard view, but I think, as we've said already, for EM kind of banks, especially here in Asia with what's happening in China, the skew is to the dovish side. What's actually interesting is Bank Indonesia, which has actually been holding up rates a lot more than others, so to speak. So that I still stand with that. Of course, US China is going to dominate. We'll also have the repercussions and tabulations of, the consequences of the EU parliamentary kind of vote. So that's also there. There's not too many Fed speakers either coming through. One thing that could be big is this RBNZ financial stability report. Their governor will be talking about it. I already saw a few headlines on it early doors, and I believe also yesterday night over the weekend. And it does not look like it's going to be too onerous. It looks at least like there's quite a bit of kind of flexibility and openness on their side. So maybe that could actually have a positive impact on Australian banks, depending on how that's kind of interpreted. But Again, food for thought there. It is a long weekend in the U.S. It's Memorial Day, so you can imagine that quite a few people may also even be off today. I can even see from the participants. So it could be a little bit of a quiet start to the week with the U.S. being out and maybe not as much liquidity as is usually kind of the case. We'll also have, in addition to Orr, Kuroda also speaking, as well as Northbank's Olsen. And worth noticing that on Thursday is quite a few Eurozone bank holidays as well. With that, let me just pass it over to Raymond before moving back onto the.
Hi, good morning. I just want to share what we have seen on our side about an increasing volatility on the Chinese interbank rate, repo rate. In the chart, in the chart below, it's actually showing a span of 5 years, going back as far as 2014, when we were seeing a supply draft in the year, where money lending rate has been shooting up high above 3.5. But going into this April to May, we have seen a comeback in the rate. If you see from this chart going into these 2 months, we are seeing a high about on April 17th, where it's reaching close to 3%. But then the swing quickly put that back into the 1.1% to 1.5% range within less than a month. And this is going to put people doing carry trades in a very difficult situation, as it creates uncertainty and difficulties to benchmark their funding rate. And also for people who are trying to leverage funds from a lower repo rate into hello. Okay, sorry. So what I was trying to say is that we are seeing a difficult time for people who are trying to leverage the lower funding rates for doing fixed income trades. So even the local traders are trying to see past what's the impact for the monetary policy to doing the currency supply. So we may want to watch out for the further monetary policy in terms of in the times of heated trade dispute headlines coming out like almost every day. Reserve rate ratio and also the credit lending facility side of actions is what we should be focusing to get a hold of the solid funding rate. And it is to be believed that the PBOC expects the same pace going on into the near future. So I'm not sure how well the recording is for today, but then I'll try to improve it for the coming days. With that, I'll pass it back to Kay. Thank you.
All right. Thanks, Raymond. Yeah, we'll get that mic fixed. It's a new one we were trying this week, but we seem to still have the same issue. Sorry about that. So moving on just quickly, really on the charts. Predominantly currency charts, but I start off with two equity ones. So this here is showing you the SOXX, which, if you don't know, is the Philadelphia Semiconductor kind of index. And it had a massive run towards the start of the year. Obviously, we'd had that big sell-off, and it was also completely on fire last year. So we'd up about kind of 40%. We've had about, call it a 17% pullback, still up 15% year to date. Now, a lot of this basically is also linked to China and the Trump tweet and so on, and where this potential tit for tat tirade could kind of go on targeting kind of companies and component kind of makers and so on. So this again is something that everyone should keep on their radar, whether it's in regards to playing for further kind of deterioration, for playing for kind of a bounce back, etc. What's very interesting to me in this is also the fundamentals in regards to kind of inventory data from an industry perspective don't really seem to have been justifying the heights where we were, neither the heights where we kind of are now. So if we were to actually have things get worse, Peter Gonry, our equity strategist, expects like this index to potentially kind of get a lot worse. So, some of the individual names. Also, food for thought from a long-term, let's say, hedging perspective for a portfolio. You can get 1 to 2 year leap options on this. So if you're kind of playing a recession play and you want to take 1 or 2 year puts or put spreads on these, it's worth bearing in mind in the last previous pullbacks, so the GFC and the dot-com, this index tends to tank, upwards of 80%, right? So But again, that's having kind of the timeline to do it. As we've also seen during risk-on periods, it's just absolutely on fire. This is just a daily chart. Obviously, very much everything kind of tilting kind of towards the bottom. Could be interesting to see whether or not we hold this kind of 200-day per se. And of course, that theme can be taken into individual names. I just took out Apple. This, I think, was something we were talking about a few weeks back. If you were at the Traders Lunch I hosted on Friday 3 weeks back, a very kind of savvy trader did flag this when we were still above kind of, 200 kind of bucks, and now we've broken kind of south of the 200-day, which is 190, and we're here. It goes without saying, again, if there were targeted attacks or retaliation, I guess is the better word, bearing in mind that Huawei has not been proven of anything from a guilty or court verdict perspective. So if we were to see a bit of a reversal, I think this could easily quickly get to 150 kind of 160 kind of levels on the likes of their reliance on China, not to mention even just kind of soft patriotic kind of boycotting, which we're starting to hear a little bit of kind of through the channels that's kind of already kind of happening without even really the government kind of initiating anything. So, and again, vice versa. If resolution, things are savvy, happy, then we could again see a massive kind of rewind there. Again, same thing here. We're not really seeing any turns in the RSI or the MACD. Moving on to kind of currencies kind of side. This is Euro. Again, interesting. Probably a little bit of kind of risk off. This is the daily charts going into kind of the EU kind of parliamentary kind of election. This move here seemed to have happened on Thursday. We had misses on European PMI, but that big move up seemed to have happened when we had misses on the flash PMIs in the U.S. As you can see here, RSI is moving up, and the MACD is crossing up, so that's actually constructive. Potentially maybe even suggesting that we may take out recent kind of highs and then try and get to kind of that 113 level. But I think this would be more a dollar liquidation story rather than necessarily a euro story, just given where yields kind of are and so on. And it's really also watching yields in that kind of front. This is euro sterling. I think a big part of this move was, again, also potential risk of monetary kind of union of the eurozone, so i.e. maybe more anti-euro skeptics, making it difficult for Brexit. From what I've seen from the preliminary results, this does not at all seem to be the case. And a lot of sterling crosses are looking overstretched and looking potentially to kind of reverse. Obviously, I actually forgot to comment about Theresa May resignation. I believe June 7th is the date that she has kind of set. The consensus view there is obviously bearish. It's not going to make a difference. Whoever kind of comes in, worth bearing in mind, sterling, I believe, did rally, though, when she announced the news. And Brussels can't be seen doing a better deal for someone else who's kind of come in through. So I'm not trying to say the consensus view there is wrong or right. I'm just kind of stating as it is. I'm still kind of digesting, and here I'm really just kind of trying to point out the technicals, so to speak. I have seen more and more people now saying her leaving is more increased probability for a harder Brexit. I'm not so sure about that, to be very honest with you. But I'm seeing more and more calls for, let's say, us getting to 90, maybe even 94 out there, food for thought. But again, here I'm looking at RSI's crossed back, MACD, Instagram at least seems to be kind of pointing down. We may be looking to make a cross down lower. So it could be interesting. And for those of you who are maybe very, very kind of tactical and short term, you could just have like a stop loss of, above kind of one of the recent kind of highs. For those of you who are a lot more strategic and let's say would like to play a move to kind of 85, then obviously you may want to entertain, maybe a new high kind of stops or 89 or something kind of like that, so to speak. And if you want to factor in potential hard Brexit scenario, then of course you have to probably get above kind of 91, right? And probably leave some dry powder because you'd probably want to be adding post that kind of event. So this here is Sterling Swissy, flagged to me over the weekend by a very, very switched on trader. Again, looks very, very much kind of overdone to the bottom side. Looks like we did make a base on, a few days back. Again, can it hold that? Depends to be seen. Looks like RSI is coming back up. So as kind of the MACD, looks like it could be an easy target play to kind of 129 and 130.5, especially also if we had that combined risk off situation helping Swiss francs as well and hurting kind of sterling. So this could be kind of a potent kind of play on EU monetary kind of, parliamentary kind of elections. Here's just cable. Ditto again, looking kind of constructive for sterling versus shorts US. This is Euro Kiwi. It's actually a little bit one of more of my favorites in the sense of I think kind of Kiwi's just been under a lot of pressure for quite a few sessions, given what's been kind of going on. We've seen the MACD kind of cross lower. RSI has already kind of turned. Can have just recent stops if this kind of view is kind of correct. So maybe 172. Easy target to 169, 70-ish kind of levels. And if you're looking for a little bit more punch, 167.40, 168, even though we may need to see U.S. kind of China relations there improve dramatically or signs of things here. This is Euro CAD. This again is interesting because, like, to me, I think CAD should be a lot stronger across a variety of crosses, given the combination of oil, even despite that sell-off last week, the diverging kind of data we've been getting in some of the Canadian kind of, economies, and we still have not kind of seen that. So this is EuroCAD, so it could be interesting from a Bank of Canada perspective, as well as, whether or not it fails to, again, stay above that kind of 200 day moving kind of average. This, of course, move here was when we basically had oil getting absolutely its tail handed to it in the kind of the fourth quarter, last year. So I don't think a situation like that is highly likely to kind of repeat kind of itself. And again, you can see an easy kind of move to, let's say, 150 and 149.5 and so on for kind of views there. This one is dollar CAD. Again, just kind of showing that thing. I was expecting us to maybe already be closer to a figure kind of lower towards kind of the 100-day rather than where we've kind of been. A little bit more inconclusive on an RSI and MACD kind of perspective. This here is an Aussie yen. So for a lot of you, if you remember, we were talking about this last week where I thought we were going to potentially have a big kind of squeeze high in the likes of Aussie yen and Kiwi yen. And again, we just have not had that yet. We've kind of continued to kind of break and make new lows. Been a little bit kind of, I don't want to say frustrating because it is what it is, right? But we are seeing RSI still tilting up, MACD still trying to kind of grind up. So again, this can be either waiting for price confirmation to get involved or cheekily putting longs with a short stop for, let's say, the lows from last week. And for those of you that want to be still playing the kind of the bearish perspective, maybe using the highs from last week as a stop. This one here is Kiwi yen. Again, something that I think has a lot more kind of spring kind of to it, in essence, where I moved to kind of 73, 74, and even 75, I think could be happen in just a spur of a few sessions. So maybe it's just to wait for a little bit more confirmation again on U.S. kind of China, trade views. I think a bearish side, it gets a little bit tougher, right? Because you're talking about potentially kind of uncharted territory. You got to pull out kind of wider charts and so on and so forth. But of course, if we had a massive escalations, both of these crosses would completely get hosed. This is dollar CNH, showing you a little bit of stabilization around these kind of 690 kind of levels. Seen a lot more people talking about 7 as we talked about and we anticipated. This probably is the best barometer. If anyone's seeing a quick move, sub 690 towards 685, and there's nothing really from a headlines perspective, you can probably bet that some good news is coming along the way in regards to kind of U.S. kind of China, either trade deal or resolution kind of coming through. Nice cross down on MACD, nice cross down on RSI, but obviously this is very kind of potently dynamically driven by any kind of headline. And this is just showing you the stress that we're seeing in some of the China kind of proxies, the biggest trading partners of Taiwan, Korea, big weakening in those kind of crosses. Again, also key barometers to kind of watch, which is what I mean. If you're just watching like volatility of, let's say, the VIX, it's not necessarily telling you the stress from a cross-asset as well as geographic kind of perspective. And again, even on a multi-year charts, these look even a lot more dynamic and drastic on a weekly kind of basis. And just the same kind of idea here on the yuan. And this, again, may also be linked to Bank of kind of Korea potential, maybe surprise rate cut, maybe not a surprise rate cut this week. Of course, they also have to balance those potential moves with relations with, let's say, the U.S. But the net takeaway here is if things get worse between the U.S. and China, you're going to see this race to the bottom, right? Because probably 9 out of 10, then we'll get the yuan kind of going through 7. Right, is kind of a base case view kind of tend to have now. With that said, do please join us again next Monday. After that, I'll have my annual Europe trip to go to the CPH kind of headquarters, so we will not actually have Macro Monday for the 2 Mondays post that in June, so just keep that in mind, but we'll definitely be very much on next week. Let me wish you all a phenomenal, growth-filled, fun, and profitable close to the month of May.